Hey, welcome to my YouTube channel. I am Xavier Smith, and today I'm going to go over some investment tips for beginners. So, if you're new to investing, you are in the right place. So, stick around because I think these tips will really help you. So, let's get into it. So, first off, why even invest in the stock market? Well, over the past century, the stock market has yielded 7 to 10% gains per year with inflation. So, that means every year your buying power is going up 7 to 10% between last year. And that's with inflation, which investing in the stock market therefore yields much more than if you're just investing in a savings account, which just barely outpace inflation. So, when you invest in the stock market, you're not just putting money aside, you're actually letting your money grow through the power of compound interest. So, let's look at an example. If you were to invest $100 a month starting at age 25, when you are 65 years old, assuming that you get at least a 7% gain per year, you would have $265,000 when you're only putting in $48,000. In a savings account, you may have something close to that, $200,000, but with inflation, it's not really worth that much. So in the stock market, your money's actually growing and you can pay for more, and inflation doesn't really matter to you. And you can see here, you only put in 40 grand, but you're coming out with 250 grand. That is compound interest because you get 7% this year, and then the year after that, you get 7% on top of the money you already had. So if you have $100 the first year, then the second year you'd have $107, right? But then the next year you're getting 7% on that. So on that $7, I don't know, it'd be probably less than $1. So you'd probably have like a 114.50. Like you'd get more than $7 the next year. So here's the key. It's not trying to time the market and buy low and sell high. The key is to actually have time in the market because over time the market will go up. So if you invest in like an ETF or a full market fund, then over time you are going to make money. So first, you are just going to want to learn the basics and educate yourself. So maybe look online for some free sources or go buy a book from the store called like Stock Market for Beginners, or watch someone's YouTube videos like I'll be making some in the future, or this one right now, and just educate yourself on the stock market so you can make good decisions in the future. So here are the basics. A stock is like an ownership of the company. So if you buy a stock of something, you're becoming a part owner because these companies can set aside like 20% of their company is the public can just invest in it, right? And then the rest, like the people that own the company can actually like own it. So you're buying a part of the company. You're paying to be an owner of the company. So you have to make sure it's a company you'd actually want to be the owner of in the future. And if the company does well, people are paying more to be owners of the company because the company's worth more money, they're doing better, and people are like, okay, I'll pay more money than you to be owners of the company, like a part owner of the company. So if the company does well, your stock rises in value because your ownership is now worth more, right? Because more people want to take that and they want to be an owner of the company. And then you can also earn something called dividends, which is like a stock just saying, well, a company saying, thank you for holding our stock, right? And therefore, we're going to pay you like 1% a year. And it's like, okay, it's nice to have this little bit of income while you're just being an owner of the company, but every year they're going to pay you like 1%. They're going to say, okay, here's 1% of your money back. Thank you for being an owner, and we'll see you next year to pay you again. Then there are ETFs, which are exchange traded funds. And these are basically just a bundle of stocks that are pre-diversified for you. So you can look at ETFs and people are like, okay, this is an ETF that's running a bunch of these big companies, right? They're like Amazon, Apple, I don't know, Tesla, right? Just all these big companies. And you can invest in this ETF and it automatically puts some of your money in each of those companies, depending on like if the ETF is like 20% Tesla, 10% Apple, 10% Amazon, right? Then it'll say, okay, you put $100 in, we're going to put $20 in Apple, 10%, well, $10 in Amazon, $10 in whatever the other one was. So in ETF, you can invest in it and it will average out the returns of all of those companies, right? And then therefore it will be going up. So it's automatically diversified. So it is safer than just investing in any one of those companies. But since it combines all of their gains, right, it averages out the losses and the profits and therefore it's really steady going up if you pick a decent ETF. And then there's index funds, which I basically think are the same exact thing as ETFs. And to you, it might not even matter to know the difference. But an index fund is basically, instead of an ETF where they can invest in like all these different sectors, right? They're like, oh, Amazon, oh, Apple, like they're different. But in index funds, they just invest in like one sector. So think the S&P 500, which I guess its sector is the 500 most popular stocks. But then there's index funds for like the technology market, the, I don't know, consumer market, right? Consumer goods. There's the healthcare market and technology. There's just all these index funds that's like, if you think technology is going to do well in the future based on your educated research, which most people don't do. But if you think technology is going to do well in the future, you can invest in a technology index fund and it'll automatically diversify you across a ton of these different technology companies. And therefore, if technology does do good, your index fund will shoot up and that's your profit. And if some of those technology companies do bad, which some of them always do, it'll negate those losses and you'll be set. So understanding these terms will help you make more informed decisions and not invest something you don't know anything about. So always make sure if you're buying into an ETF or an index fund, it is in something you trust. Just check what they comprise of. If you're like technology index fund, it's probably one you'd want to go into if you want to get into technology. If you're buying a random ETF, you might want to just check down below it. It'll say it's like 20% like technology, 10% consumer goods. And I think you can click on that and it'll also tell you what stocks they're in. So before you start investing, you want to ask yourself, what am I investing for? And this will determine your strategy in the stock market. So if you're investing for the short term, like 3 to 5 years, like you're buying a house or you're literally about to retire, you might not want to invest in stocks because they can be super volatile. You could go into something safer, like an ETF or an index fund, but still they can be pretty volatile. So you might want to get into bonds, which pay you a specific like percent per year, and they have room to grow in value, right? But then you could also just go into a high yield savings account, which won't really get you any purchasing power over time because inflation knocks away all of it or just a little less than all of it. So if you're going longer term, you'd probably want to do stocks. But if you're going short term, like house, retirement, well, retirement, if it's like 3 years away, probably go towards something that's not going to make you as much money, but is not very volatile. And then on that, if you are investing for the long term, like retirement or your kid's college, your unborn kid's college or something, the stock market is a great option because although it's volatile now, if you invest in the full market or just in a company you really believe in that's down right now, over time, they always go up. Well, the market has always been proven to go up and it's always reaching new highs. Well, at least in 2024, it is. So in the longer term, the stock market will make you a lot more money. But in the short term, the volatility of the stock market can really tank your gains. It could drop 30% in a year, but over time, it's probably going to go up 7% per year. So longer term goals, focus more stock market. Remember to diversify. And if you're going shorter term, probably go bonds or high yield savings account. So actually having clear goals will help you so much in your investment plan because you will realize how much risk you are willing to take on. So risk and reward do go hand in hand. So if you're being a little more risky with stocks, your reward is a lot higher. And if you're being super safe in going high yield savings account, you're not going to make that much money, but your money will be there when you take it out. So to start, just start small and diversify. So if you don't have that much money and you're saying, dude, I only have $100, how can I get into the stock market? Well, you can buy fractional shares of an expensive company with like as little as $10. And remember to diversify. So you can get into like Apple, even though the stock's like $220, you can get in for $10. And then you can get into 10 big stocks with just your $10. So you can diversify and get into all these companies you love with a little bit of money by buying fractional shares. Or you can get a cheap ETF that has all of those funds in it, well, has all of those stocks in it. So if you're like, I just want a big market fund, right? I want to do well in the future. You just say, okay, S&P 500, I can buy like a 50th of a share for $10, but you could buy a fifth of one of the shares for your $100. So just buy partial shares and then just invest in a ton of things and diversify and just keep doing this over and over. And over time, your money will grow. If you keep putting money in, it just keeps fueling the fire, and exponentially, your money will shoot up. And you are going to make so much money in the future if you just trust me, stick in the market for the long term. Just keep investing consistently and keep getting that compound interest from full market funds or from getting the I don't know, stocks you think are going to do well in the future, like Amazon. Okay, do your research. So you might want to research into these stocks you're getting into, because if this is your future you're depending on, you want to make sure you're in something stable. So first, you're just going to want to look, is it growing, right? Do you think that it's growing in money over time? You can look at its earnings expectations. You could go on Yahoo Finance and check out oh, this was its earnings today. Well, last year, 10 million, and then it's got 15 million earnings, which aren't that much, as they're not as much as they sound. But most of the time, if you don't want to do the research, like I don't want to do it, if you don't know what to look for, just say, is this a company I know, right? Like if you see Starbucks and you're like, I'm in high school and I see all these girls going to Starbucks every day and they're paying $8 for that same drink, like 7 times a week, that's $56 a week. And that's for one girl. I mean, they don't get it every day, but they love this stuff. So if I see Starbucks and I say, wow, the peak was up here, right? It's down here now and it's just starting to come back. You just say, okay, I know this company. Well, you might not even love the company, but other people around you may love the company. And you say, it was up here, now it's down here, right? Just say, does this look reasonable to buy? Don't buy when it's at its peak. I mean, you never know when it's at its peak, but don't buy when it's way up here, right? You can wait for it to come down. And if it never comes down, well, great for the people that invested in it, and you can find another company. So you just say, is this a company I know? Is this a company I would like to be an owner of? And you say, okay, it was this high. Now it's down here, and I think it's coming back. It looks like it's at a reasonable price. And you could even look at the fair price estimate that is down below, or look up on Morningstar. Robinhood, I love. It just says it below Morningstar's thing. But if you look up Morningstar and type in the stock, they'll tell you their price they think it should be. And if it's at that price, maybe a little lower, preferably lower than that price, and it's a company you love, then why not get into it? Or you could look at, is its profits growing over the years, which they always fluctuate. How much debt does it have? Does it have too much debt? I don't even know what that means. And then also, is the industry expected to grow in the future, right? Like if you're in a coal mining industry, actually, that might be decent. I haven't looked into that. But if you're in the technology sector, it's probably going to grow. So you can just say, I think it's going to grow. A lot of times when you're not putting that much money into the market, it's not too serious. But my main thing is just make sure it's a company you know and that you love, or your family loves, or your friends love, and just look at the graph and say, does it look like a reasonable time to buy? And if you can't decide a reasonable time to buy, what you can do is you can buy some now, some tomorrow, or some next week, some the week after that. And then by doing that, if you put the same amount in, it'll average your price through them. So if you buy down here and it goes up, it'll average your price to the middle. If it goes here, then down, then up, it'll just average your price. And over time, if the stock is going up, you're going to be making profit, because you're averaging up, but you bought lower. If it's going up, you are going to make money. And if it's going down, then you're buying all the way it goes down. And by the time it comes back up, because it's a stock you like, then your price is going to be, instead of buying all of it up here and it went all the way down here, your price is going to be here, right? And then if it shoots way up, well, your price is here, so it's lower than before, and it'll make you feel more secure. Trust me, it's called dollar cost averaging. Made other videos on it, so let's keep going. All right, now here is one that can save you a ton of money. Try not to let your emotions drive your investment decisions. So the stock market is volatile by nature, right? If the stock market stayed stagnant, no one would invest in it, and that'd just be weird, right? That's the opposite of the stock market. So stocks will go up and down. And on the daily, a stock could shoot up or it could shoot down, like very drastically. And if a stock shoots down 20%, it could just be because of like earnings or bad news or something. But the thing is, try to focus more on the future. Try to focus on why you bought the stock in the first place. You said it's already at a good price. I already want to own it. I want to be an owner of this company. Why get out for less than I got in, right? And if it shoots up, I mean, a lot of times I'd probably sell it. But the thing here is when the stocks are really volatile, the key is to just try to stay calm. And one way to do this is, first of all, don't have your app like on your home screen where it says like how much you're up today. That's what I have. And I look in the morning, I'm like, I'm down $1,000. What the heck? But at the end of the day, it always works itself out. So maybe try not to look at it as much. Maybe look at it like every other day. Or if you're just investing in like the S&P 500, you don't even have to look at the market unless you have more money to put in, right? If you're doing covered calls, which I honestly suggest everyone should do, you really only have to look at the market once a week. So just try to stay calm and don't look at the market that much. So here's an example. Historically, during market crashes, investors get out because the market dropped a lot. But then when you see it keeps dropping, it means people keep selling. And that is just locking in their losses. But also historically, the market is hitting new highs over and over again, like every couple of years, right? So the market is always bouncing back and going higher. So if you just ride out the lows, you will benefit from the highs. So try not to just sell when everything is going down. If you picked out your stocks right, which, like I said, it's kind of just a company you think is going to do better in the future, right? Because you're going to like investing more if it's something that you believe in, right? So if you think it's going to do better in the future, why not just hold it? Like if you're like me, when I bought Tesla and it went down 25%, you know what I did? I literally deleted my investment app. I deleted it. My stocks were still there. My account was still there, but I just deleted it and I didn't look at it. And guess what? Tesla went up that 25% and then it went up like 40% from there. So if I just write it out, it works out because it is a company I believed in. Okay, finally, just learn about fees and taxes because they can really eat away your gains over time. So you might want to find a platform like Robinhood that doesn't take many fees. And when you are looking at these taxes, holding a stock longer could make you pay less taxes. And then also, there's a ton of things you can look into about like when you sell a stock for a loss, you can write it off as a tax if you held it for so long. So just look into those. They're always changing. And with Trump coming in as president, he does a lot about the stock market. So you're going to want to look into that, and I might make another video about it. Who knows? So watch out for trading fees. Some of these trading companies actually charge commission fees per trade, but a lot of them are now commission, like they don't have any commissions or fees. So they are perfect for people that are trading in and out of stocks day in and day out. Also, watch out for expense ratios. These are fees for people managing ETFs or like index funds because clearly there are people managing and changing these funds over and over and they need a salary. So they're going to take some of the money you put in. So an ideal amount for them to take would be like 0.1% or lower. Anything more, like if it's 0.5%, it's like you're putting in $100 and they're taking they're taking 50 cents. It's not that much, but as you start putting more money in, like you're putting in 10 grand, they're taking like $50 and you're like, dude, that's $50 that I have to gain back now. So just try to look out for those. Okay, yeah, and then the last tax is just capital gains tax. Basically, if you get a profit on something that's not in a Roth IRA, you do have to pay taxes on it. I know it sucks, but if you hold stocks for a long enough time, you actually have to pay less taxes, less capital gains tax, which is super nice. So just think long term with your stocks. And if you're just gonna like trade in and trade out, just remember you're gonna be paying high taxes on those. And if you are holding like the S&P 500 for like 5-10 years, you are going to be paying less taxes. So there are a lot of advantages for long-term traders. All right, finally, just be patient and consistent. If you are just investing for your retirement or something, just set up something where you're investing a little bit, like the same amount every week every month or every year, I guess, if you want to go to that. I'd say like every week or every month into probably, if you're going for retirement, just like an index fund. Or if you really like Amazon and you think it's going to do better, you're like, I'll put $10 in a week, right? Just set something like that in, and you don't even need to look at your account, right? Over time, your costs are going to average out to be like the even of where it's been. And if it goes high, you are going to make money. So it doesn't really matter where the stock is today. If you think it's going up in the future, then just put a little in every week and just be patient, be consistent, and you will make a ton of money in the future. I believe in you. So if you want to keep investing, please check out my channel. I'm going to be making a ton of videos over winter break just for you beginning investors. And I think you're going to love it. I absolutely love investing, and leave any comments down below. I'd be happy to answer them. Also, I'm very sorry for filming this video vertical. I didn't mean to, but I was halfway through the video and I realized it was vertical. And I was like, shoot, I guess I got to keep it. Yeah, I make this mistake too much. But I hope I will see you guys again next time, and thanks for watching.